Something broke in global finance in 2024. Not loudly, no crash, no emergency Fed meeting. It happened quietly in a bond market most people have never looked at, in a country most investors stopped thinking about decades ago. But the effects are already in your mortgage rate, your stock portfolio, and the cost of every dollar the US government borrows. And it traces back to one country, Japan, and one trade almost nobody has heard of. Because if you've been wondering why mortgage rates won't fall, why stocks randomly freak out every few months, and why the Fed can cut rates while financial conditions still feel like a vice grip, the answer isn't inflation. It isn't government spending. It isn't the guy in the Oval Office. The answer is in Tokyo, and more specifically, in the most boring asset on the planet, Japanese government bonds. Japan, a country that most investors stopped thinking about 30 years ago. Best known for anime, vending machines, and cultural exports. Not for being the single most important player in global fixed income markets. And yet, that is exactly what Japan became. Quietly, without fanfare, without a headline. The duct tape holding the global financial system together for 3 decades. And right now, that duct tape is starting to peel. To understand the mechanism, you need 30 seconds of context. After Japan's asset bubble burst in 1992, the country entered a prolonged period of stagnation. No growth, no inflation, no wage expansion. The Bank of Japan cut rates to zero, then below zero, then introduced yield curve control, which really just means we're going to cap long-term bond yields whether the market agrees or not. They superglued rates to the floor and kept them there long enough that an entire generation of global investors built their models around the assumption that this was simply how the world worked. Japan's domestic bonds yielded nothing. And that one fact set everything else in motion, which created an obvious problem for every Japanese investor with a portfolio. If your domestic bonds yield 0%, you have 2 options. Accept nothing. Or go shopping overseas. They chose option 2. And that decision, made quietly, institution by institution, across pension funds, life insurers, and banks throughout Japan, became one of the most consequential capital allocation shifts in modern financial history. It happened so gradually that nobody gave it a name until it started reversing. Meet Peter. Peter is not Japanese, but Peter spotted the same opportunity that Japanese institutions did. He goes to the Japanese market, borrows yen at near zero rates, converts it into dollars, and buys U.S. Treasuries yielding 4%. After hedging costs, he pockets the spread. That is the yen carry trade in its simplest form. And when your borrowing cost is effectively zero, you do not stop at treasuries. You buy tech stocks, real estate, emerging market debt, private equity. Anything with a yield above zero becomes attractive when your funding cost is zero. The trade scales naturally into every corner of global risk assets. And it did. For decades, cheap yen funding quietly underwrote a significant portion of global investment activity. Not because anyone planned it, but because the math made it inevitable. Japan did this at institutional scale and at a size that dwarfs anything Peter could put on individually. Japanese life insurers alone held hundreds of billions in foreign bonds. Pension funds systematically reallocated toward overseas assets. Even retail investors got involved through trusts funneling yen savings into foreign markets. They became the largest foreign holder of U.S. Treasuries, one of the largest buyers of U.S. mortgage-backed securities, the world's largest net creditor nation, the formal term for the world's ATM. It wasn't charity. It wasn't strategic alliance. It wasn't geopolitics. It was pure math, repeated at scale for 30 years. At its peak, the yen carry trade was estimated by some banks to be in the trillions. Global markets were running on Japanese Wi-Fi, and almost nobody knew the password. Now here is where it stops being a Japan story and starts being your story. Because the mechanism that kept your borrowing costs low, inflated your stock portfolio, and made the 2010s feel like a decade of easy money was not Federal Reserve policy. It was not American ingenuity. It was a country on the other side of the planet with nowhere else to put its money. Ray Dalio has been specific about exactly what happens when that changes. Watch the bond market. The bond market is the basis. It's the backbone of all markets. It is the risk-free interest rate that determines what all asset returns are going to be. And when there is a breakdown of the supply-demand picture for the bond market, you see long rates rising relative to short rates, the currency go down, gold go up. When that happens, it puts the Federal Reserve and other central banks in a bind. Japan was the demand side of that equation. Japanese institutions weren't buying treasuries because the yield was attractive. They were buying because the alternative, sitting in domestic bonds at zero, was worse. That kind of buyer does not negotiate. They do not wait for a better entry. They just absorb, quarter after quarter, year after year, with the consistency of an institution with no better option. And that absorption, steady, silent, decades long, kept long-term U.S. yields meaningfully lower than they otherwise would have been. Lower mortgage rates, lower corporate borrowing costs, higher stock multiples. The entire financial expansion of the last 3 decades had Japanese demand quietly underneath it, like a foundation nobody thought to inspect because the house never shook. The 2010s bull market, the post-2020 everything rally, the era of near-zero mortgage rates. All of it was built in part on the assumption that Japan would keep recycling its surplus into Western debt markets indefinitely. Then in 2024, the Bank of Japan ended yield curve control, raised rates for the first time in 17 years, then raised them again. The S&P 500 dropped 6% in days. Japan's Nikkei fell over 12% in a single session, its worst drop since 1987. That was not a random correction. That was 30 years of assumptions getting stress-tested in real time. And they cracked. When Japanese yields rise, the carry trade math flips. Borrowing in yen gets more expensive. Hedging currency risk gets more expensive. The spread that made the trade work for decades compresses. The no-brainer becomes a question mark. And when the math flips, the capital flows flip with it. Money that spent 30 years flowing out of Japan starts flowing home. Japanese institutions that were recycling trade surplus into U.S. treasuries are now looking at domestic assets that actually yield something. That is repatriation. And it does not announce itself. No press release. No Bloomberg alert. No single identifiable moment. Just a quiet structural reduction in demand for the paper that funds the American government. Quarter after quarter. Largely invisible to anyone not watching closely. The carry trade built over 30 years. It will not unwind in a single week, but it is already moving. And in markets, direction matters more than speed. A buyer that absorbed trillions over 30 years does not need to sell anything to cause damage. They just need to stop showing up at the same pace. That alone is enough to shift the supply-demand balance in a market the U.S. government depends on every single quarter. The Federal Reserve controls short-term rates. The overnight lending rate between banks. That is the lever everyone watches. Everyone analyzes Powell's press conferences like it's a GTA 6 trailer. But the 10-year Treasury, the 20-year, the 30-year, those yields are set by supply and demand. And the United States is running trillion-dollar deficits annually. The Treasury has to issue massive amounts of new debt every year just to cover spending that already happened. Someone has to absorb it. For 30 years, Japan was a core part of that absorption. If they step back, even gradually, yields have to rise to attract different buyers. That is arithmetic, not theory. And those different buyers are not structurally forced. They negotiate. They want compensation for duration risk, for inflation risk, for the sheer volume of paper hitting the market every single quarter. The yield has to move to clear it. And that is how you get a situation where the Fed cuts the federal funds rate, short-term yields fall, and long-term yields barely move. Or quietly drift higher. The Fed cut. Your mortgage rate did not move. Almost nobody looked at Tokyo. Now you know why. When long-term yields stay elevated, it becomes an everything story. Stock valuations compress. Analysts discount future cash flows using long-term yields as the baseline. When that rate rises, the present value of future earnings falls. It does not matter if a company just posted record profits. Investors pay less for every dollar of future earnings when the discount rate is higher. The multiple contracts quietly, in the math, before anyone on CNBC has decided what to call it. Mortgage rates stay high. They are anchored to the 10-year Treasury, not the federal funds rate. The Fed can cut all it wants. If global demand for long-term debt weakens, the 10-year stays elevated. And if the 10-year stays elevated, mortgage rates stay high, housing affordability stays broken, and the market stays frozen. Existing homeowners locked into 3% mortgages from 2021 won't sell. New buyers can't afford current rates. The whole market sits there, stuck, not because of anything Washington did last week, but because of what Tokyo stopped doing this year. That is not a political story. It is a plumbing story. Plumbing is invisible until it is not. Corporate credit tightens by the same logic. In 2020 and 2021, companies issued debt like it was Black Friday, and interest rates were 90% off. Investment-grade companies locked in financing at 2%. High-yield issuers that probably should not have had market access got it anyway. That cheap capital drove deal flow, buybacks, acquisitions, an entire generation of venture funding that would not have existed without it. When borrowing costs stay elevated, you get the reverse. Risk appetite falls. Leveraged companies struggle to refinance. Capital expenditure slows. Hiring slows. The machine runs colder across every sector that borrowed against the assumption that cheap money was a permanent feature of the landscape rather than a 30-year subsidy from Japan. Credit is the bloodstream of the corporate world, and the source that kept it cheap for 30 years, a country on the other side of the planet with rates superglued to zero, is no longer cheap. The math is changing. This is not a prediction about what might happen. The carry trade is already unwinding. Japanese yields are already rising. Repatriation is already happening. The question is not whether this matters. The question is how far it goes, and the honest answer is that nobody knows. If the unwind stays gradual, you get rates higher for longer, housing stuck, corporate margins compressed, growth disappointing without a clear villain to blame. Painful, but contained. If it accelerates, long-term Treasury yields spike. The Fed faces a choice between cutting to stabilize growth or holding to defend the dollar, and there is no clean answer at that point. That is the bind Dalio was describing. That is what a supply-demand breakdown in the bond market looks like in practice. The loud risks are always priced in. By the time a recession makes Bloomberg's front page, the market has already moved. By the time a banking crisis has a name, the stocks are already down 80%. The risks that actually do damage are different. They build slowly, in the background, in places nobody watches. In bond markets, nobody tracks. In a yield that moved 3 basis points overnight while you were asleep and quietly made everything slightly more expensive for everyone. The subsidy is ending. Slowly, structurally, and almost completely out of sight. The carry trade that quietly funded the American financial system for 30 years is reversing. The biggest foreign buyer of U.S. debt is stepping back. And most of the people who spent 30 years benefiting from it, in their portfolios, in their mortgage rates, in the valuations of companies they work for, have no idea it ever existed.